Welcome back to the Deal Mastery Insider. I'm excited to unpack this deal today. A lot of the deals I look at or come across just aren't that interesting, and sometimes it's fun to show you guys why a deal is a bad deal. But this case, I think this deal is actually really interesting, and even with a pretty conservative underwriting approach, I still think the deal actually makes a lot of sense and gets pretty compelling. So with that, let's jump right in. This business is a distributor of mission-critical fastening systems, doing about 1.1 million of EBITDA. So they do all kinds of stuff. Looks like structural fastenings such as tension control bolts, anchor bolts, torque wrenches, clevis assemblies, and hex bolts, construction, steel, alternative energy, etc. Would want to understand the end markets that they're serving, especially given that in today's market, there are at least some concerns about recession. And so understanding who they're selling into, if it's primarily construction driven, are there any risks about that from a recessionary standpoint? If it's alternative energy, are those sectors that are growing? Are those sectors that are facing headwinds? Those are things I'd want to understand is just what end markets are we selling into? Because ultimately we want to be selling into end markets that have really positive long-term demand trajectories, right? And really positive long-term macro fundamentals. So I'm just going to show you how I think about this going through this listing as I read through it, right? So that's interesting. Those sectors aren't bad necessarily, but they would be areas that I would ask questions about. Large inventory allows for immediate supply of goods. Large inventory also might mean that there's a decent amount of an asset base for us to use as collateral for a loan or for some kind of financing, right? So in this case, I'm going to assume SBA financing once we kind of get into the deal structure. But even if you weren't using SBA, I like the fact that they're calling out it has a large inventory. They haven't shared the balance sheet here, but that's something to pay attention to. Reputation for rapid turnaround, trademarks for some of their in-demand products, which is interesting. If they're a distributor, I wonder if they own those products. I wonder if they manufacture them overseas. I would want to understand better if they have controlled products that they actually own. Even if they're not manufacturing them, that would definitely make the business more valuable than if they're just pure play distributor selling somebody else's products. So that's something I would definitely flag or want to unpack or want to dig into. And then future stories. So there's opportunity to add marquee customers to increase revenue. I wonder how they got that number and specifically define those marquee customers. I would imagine you could add way more than 40% by onboarding new customers, but I don't know really specifically about the end markets they're serving, so maybe that's not the case. I'd also be surprised that new territories would be such a small increase in revenues, especially if the fastener market is a $17 billion market. But unpacking those and asking questions about it once we dig in would be a way to really get a better sense of that. Love the 92% repeat revenue in 23. 30% protected by automatic purchasing. That's also great. And then high margins due to vertical integration and regional sourcing. So all of this stuff generally seems pretty compelling out of the box. There's obviously some questions we don't know and can't know without signing an NDA and Sim going deeper. But if I'm looking at this on the surface, there's a number of things that to me seem super interesting. Now let's go to the financials really quickly, right? So there's some good and some bad here, right? The good news is 22, 23, and 24 forecasted, or I guess maybe run rate 24, are all relatively similar, but with a slight upward growth trajectory. I like to see a dynamic like this where a lender or investors are going to see historically, now we'll talk about 21 in a second, but historically, generally, the business was doing about 5 and change of revenue and just under or just around $1 million of adjusted EBITDA. We'd want to make sure we unpack that, understand the gross margins, get a sense of if there's any really wild and wacky add backs going into that calculation. But generally, that seems reasonable. High teens margins for a business like this wouldn't necessarily surprise me, especially if they have some trademark products and some repeat business and vertical integration sort of driving their margins up a little bit. So all of those things make sense, but I'd want to make sure they're not just window dressing the 24 forecast to get to a slightly higher number than they really should have been doing or would have been doing historically. So I want to understand that dynamic, but we'll give them credit now for our underwriting just to get a sense. So those are things I think about. I typically throw out just pure play future forecast. That's great that they think 25 is going to do those numbers, but of course we have no clue what's actually going to happen. 21, I'd really want to understand why both 21 was break even effectively or very slightly profitable, and also why there was a $2 million jump in revenue. It also looks like 23 was a little bit down from 22, so why that revenue declined a little bit. And if that jump is sustainable, was it one big customer? Was it a new product that they introduced? I'd really want to get a sense of why that dynamic took place. to understand that it's justifiable and sustainable for the business to continue to do 5.7 million or 5 and change of revenue on a go forward basis. So those are some things I like about the deal. Those are some things I would think about as I'm underwriting the deal. And let's look at just a really basic underwriting of this deal, assuming SBA financing. So I took the 1.1 million of EBITDA. I'm going to give them credit for that. Maybe we could push back and argue that it should be lower. Maybe we use the historical average to drive their multiple below a 5x. But I think 5x is a reasonable, if slightly generous, i.e. on the high side multiple for a deal like this. So I think if we underwrite this at a 5, we're going to be pretty comfortably pricing the deal. Again, maybe the seller has expectations way beyond that, but I think a 5x for a business like this, especially with some historical volatility or lack of earnings in the past, seems very reasonable to me. I estimated around $75,000 of deal expenses and working capital. It's just a plug. Maybe it should be a little higher. Maybe it should be a little lower, which gets us to a total deal expense of about $5.6 million. If we assumed an SBA loan for 80%, and we'll talk about where the other 10% is coming from in a second, be about $4.4 million. If we took in the loan payments on that at an 11% rate, would be $737,000 a year. Now, rates may be softening a little bit, so perhaps we could underwrite a more advantageous rate. Maybe we go to 10.5. Maybe we even take that to a 10 or a 9.5 or something like that. But if we want to be conservative in our initial take, I like to start higher. So we'll start with an 11. And then I'm also assuming that the seller is willing to carry some seller financing, in this case, about 10%. I assumed a 7% interest rate and interest only. Now, there may be an amortization period here, or maybe it's a balloon note. Just for ease of this example, I just assumed interest only. $550K, which is just 10% of the purchase price, times a 7% interest rate is about $38,000 or $40,000 a year of interest payments to the seller. Which would leave us needing, actually, I just realized this calculation is actually wrong. Let's see if we can go back to our formula bar. It is not taking out the seller note. So it's telling us we need way too much equity. There we go. So that would need about $500K of equity, and our free cash flow after debt service, which was just $1.1 million of EBITDA, minus the loan payments for the SBA loan of $737 plus another $40K for the seller note, would leave us with about $320,000 a year of remaining free cash flow, which is a DSCR of about 149 just on the senior DSCR, which isn't bad. It's not amazing, but it's not terrible. And that's mostly a function of the fact that we are paying a 5x multiple and we're using 90% leverage. Right. So if we get the multiple down a little bit, could make a huge difference in terms of our free cash flow and our debt service coverage ratio. Just as an example, if we assume a $4.4 million purchase price, which would be a 4x multiple, we're getting close to $500K free cash flow. And now our free cash flow is actually more than our equity investment on an annualized basis. And our DSCR goes up to 1.86 just on the senior loan. So really, really interesting. Or even if we go to let's assume 4.5 here. I'm going to do a little bit of calculating. If we go to 4.5, it's about just under $5 million purchase price, $4 million loan plus a seller note of another $495. In this case, our DSCR is still really healthy, and our free cash flow is about 80% of our equity investment. So shows you the power of negotiating a more favorable transaction multiple. We could also solve that potentially by migrating some of the seller compensation maybe to an earnout, or even going to a 70% loan balance with a 10% seller note and a 10% earnout. A lot of that's going to depend on information you get once you pop the hood, go deeper in the business, and also some of the dynamics of the deal. Is it highly competitive with tons of offers in place, or has it been on the market for a little while and maybe there's an opportunity to get a better negotiating position? So I just wanted to give you a sense. I think this is a really interesting little deal. I liked it quite a bit. And I think even at a 5x multiple, it's still pretty interesting. I think looks like there's some cool dynamics with this business. I'd want to understand the end market and some other things about it, but hopefully this is helpful as a resource for you as you think about underwriting and evaluating deals. With that, I'll see you on the next Deal Mastery Insider.